Picture this. You just finished another brutal shift flipping burgers at McDonald's. You're exhausted, scrolling your phone in bed, when that email hits. You've been paid $2,000. You open your banking app, and it only shows $1,456. Federal income tax, state tax, Social Security, Medicare. Welcome to the modern money ritual, where a chunk of your hard-earned cash disappears before you even touch it. And somehow you're supposed to feel grateful. Here's the real talk. Taxes are the price we pay for living in a functioning society. Roads, schools, public safety, national defense, yeah, that's where a lot of it goes. But taxes come in different flavors, and understanding them changes everything. Income tax takes a cut of what you earn. Sales tax hits you every time you buy something. Capital gains tax takes a piece when your investments make money while you sleep. On top of that, almost everyone pays into Social Security, basically forced retirement savings you get back later, and Medicare, health coverage for older Americans and those with serious needs. Filing taxes? The government already knows what you owe, but still makes you figure it out. Get it right and you're good. Get it wrong and things get painful fast. Some people pay quarterly, some once a year, and a few try to skip it entirely, usually ending up on the wrong side of the law. Taxes feel annoying, but countries with smart tax systems often deliver higher quality of life. The key is understanding the game instead of just complaining about it. Now let's talk about banks. You walk in, hand over your cash, they smile and tell you it's safe in the vault. Wrong. That money is already out the door. Banks are middlemen. When you deposit $1,000, they typically keep only a small portion on hand and lend the rest to someone buying a jet ski or starting a business. This is called fractional reserve banking. It works because not everyone shows up asking for all their money at once. 2008 was the painful exception. Banks make money by charging borrowers higher interest than they pay you on deposits. You supply the cash, they match it with demand, and pocket the difference. Why keep money in a bank instead of a shoebox? Convenience, safety, and they actually pay you a little interest. In the US, the government insures deposits up to $250,000 per person at each insured bank. Your money is protected up to that limit, even if the bank fails. Next up, interest, money's version of rent. You borrow $1,000 and have to pay back $1,280? That extra is interest, the cost of using someone else's money. There are two main types. Simple interest is straightforward, a flat fee. Compound interest is where the magic or the pain happens. Your interest starts earning its own interest. Miss a credit card payment at 20% interest and that $12 burrito can quietly turn into a much bigger problem. On the flip side, put money into investments earning 7% compound interest and your cash starts cloning itself. $100 becomes $200, then $400, and decades later you wake up with serious wealth. Interest is either your biggest enemy, when you're paying it, or your hardest-working employee, when you're earning it. The choice is simple. Kill high-interest debt fast and let compound growth work for you over time. Now, inflation. You buy a bag of chips and it costs 30% more than last time. Same chips, less value. That's inflation, money slowly losing purchasing power. Causes? Too much money chasing too few goods, supply chain problems raising production costs, or even people expecting prices to rise, so they spend faster, which pushes prices higher. A little inflation around the Fed's 2% target is normal and even healthy. But when it spikes, savings lose value and wages struggle to keep up. The government fights it by raising interest rates, making borrowing more expensive, which cools down spending and brings prices back in line. Recessions are the economy's reset button. Technically, it's 2 straight quarters of shrinking economic activity. One day, everything feels normal. Jobs steady, bills are paid, maybe you're planning a vacation. Then layoffs hit, stocks drop, and everyone starts hoarding cash for necessities only. Causes vary: high interest rates, global shocks, pandemics, wars, supply disruptions, or just the natural boom and bust cycle. Think of the economy like a wild party. Eventually the music stops, people check their wallets, and things get quiet. Recessions hurt, but they're usually temporary. Governments cut rates, send stimulus, and eventually spending picks back up. The economy rebuilds, just with some scars. Credit scores are that mysterious three-digit number 300 to 850 that decides whether you get approved for a house, car, or that new TV at a decent rate. It's not about how much money you have, it's about how trustworthy you look to lenders. Main factors: payment history, paying on time is huge. Credit utilization, how much of your available credit you're using. Length of credit history, types of credit you have. Recent new applications. Build it by paying every bill on time, keeping balances low, and not opening too many new accounts at once. Treat your credit score like a pet. Ignore it and it causes chaos. Take care of it and it opens doors, like buying a home. Even with zero debt, you need some credit history to have a good score. Money itself is weird when you really think about it. A dollar bill isn't real in any physical sense. It's a social agreement. We all decided this piece of paper or number on a screen has value, so it does. The same way a shiny yellow rock, gold, is worth more than an ordinary rock because we agree it is. The government prints it, central banks manage the supply, and we trade it for goods and services. Too much printing equals inflation. Too little equals people can't afford things. Money only works because we all believe in it together. Investing is how you fight inflation and make your money work harder than you do. Instead of trading time for money, you put money to work. Main options: stocks, tiny ownership pieces of companies. Bonds, basically loans you give to governments or companies for interest. Funds, baskets of stocks and bonds, easier diversification. Real estate, property that, ideally, appreciates and generates income. Investing isn't gambling if you diversify, stay patient, and give it time. Most wealthy people didn't get rich overnight. They let compound growth do its thing for decades. The biggest risk isn't market dips. It's never starting and letting inflation quietly eat your future. Value is what actually creates wealth. Plain rock is worthless. The same rock, shiny and yellow, suddenly it's gold because humans decided it's rare and desirable. Steve Jobs didn't just make phones. He created massive value that millions were willing to pay for. Doctors, lawyers, and luxury brands charge premium prices because people perceive and receive high value. Create real value for others and money follows. Even perceived value works. That's why the same handbag can cost $50 at Target or $5,000 from a designer. Finally, time, your most valuable asset. Everyone starts with a lot of it. Most people trade it directly for money. 1 hour equals 1 paycheck. High earners figure out how to make each hour worth way more through skills and leverage. But nowhere does time work harder than in investing. A little money invested consistently, given decades to grow, turns into serious wealth. Ordinary paychecks plus time plus compound interest equals 7-figure retirements. Wealth isn't built in days or weeks. It's built in decades. The people who win aren't necessarily the smartest or luckiest. They're the ones who started early and let time do the heavy lifting. These are the real rules of money that actually matter. Once you understand taxes, banks, interest, inflation, credit, investing, value, and time, you stop playing defense and start playing to win. If this video helped you see money differently or cleared up some confusion, hit that like button and subscribe for more Straight Talk Finance content that actually helps. Drop a comment. Which of these concepts surprised you the most, or are you going to focus on first? Your financial future isn't about luck. It's about understanding how the game really works. I'll see you in the next one.